First off, before I start the content on tonight's show, I want to take a moment of silence here in a couple seconds to remember Kobe Bryant, his daughter, and the victims who passed away in the helicopter crash. As many of you guys know, I grew up in Southern California, lived there over 15 years, and I'm a lifelong Lakers fan, so very, very saddened by the tragedy going on. Okay, taking a moment or two of silence. So now I want to talk about tonight's show. A little bit, it's sad, but I'm going to focus on the content with Kobe Bryant. So, sad with Kobe Bryant, but I'm going to focus on the content. Sorry, I'm mumbling my words. Okay, so WTI oil price. Oil prices have opened up, and the coronavirus's impact on the Chinese economy is already being felt in the oil market. So Chinese stocks supposedly have not dropped yet, the large Chinese stock market index, but the oil price, the WTI oil price, is now down over 2%, minus 2.12%. Brent crude is down minus 1.7%. And if you look at a chart of the oil prices for Brent crude and WTI, the oil prices look really bad in the last 3 or 4 weeks. So in the last 3 or 4 weeks, since really January 6th, WTI crude oil prices were at $63.27 a barrel, and a lot of U.S. shale oil producers locked in oil price production hedges at those prices at $63.27. And in hindsight, that was probably pretty smart to lock in oil prices for the next 2 years, an increasing amount of oil price production at those levels, because in less than a month, we are down to $53.04. So over a $10 per barrel drop in WTI crude oil prices in under a month. Now let's look at Brent crude oil prices. Brent crude oil prices have had a similar drop on January 6th. They were at $68.91, and in less than a month, they are down to $58.77. So not quite, well, it is $10 a barrel, a little over $10 a barrel drop for both. And I think what is happening right now is the market is weighing the news that just came out in the last couple hours of the missile strikes in Baghdad on the U.S. Embassy versus the impact on the Chinese economy with the coronavirus. And unless you've been under a rock for a while, there's 10 large Chinese cities, including Wuhan, where most people seem to think is where the virus started to spread. For whatever reason, there's a bunch of theories going on right now that there's 10 Chinese cities that are basically on lockdown, travel restrictions. I think there's a travel restriction on Beijing. And the market is looking at how there's going to be a lot less driving happening in mainland China. So that's impacting the market's calculations for demand for oil and gasoline. And that is why oil and gasoline are down now that markets have opened, with all the breaking news that has been coming out about the coronavirus spreading in Wuhan and other Chinese cities over the weekend. So I was not going to cover those stories about oil, but we've had significant moves in oil, and this adds to my bearish thesis, at least for the short term, on oil. So I've been covering now for weeks about the oil market with the gains in productivity on U.S. shale oil wells, and how despite the oil price, a lot of these shale oil producers were maxing out. They were running past the red line on oil production, and that's why U.S. oil production is at record highs at 13 million barrels per day of oil production. That's a high that Saudi Arabia has never done, and Russia or the Soviet Union has ever done. But the fact of the matter is that a lot of that oil production that the U.S. is producing is not economic, okay? It's barely break even. And we know this from a survey that was anonymously done through the Dallas Federal Reserve last couple weeks. I don't remember the exact date, but because I do so many of these shows, but there's a show in the last couple weeks if you want to look at the archives, where these CEOs of U.S. shale oil producers anonymously admit the real costs, which are not the costs that they're telling prospective investors, that they are telling in their investors' presentations, that Peter Zeihan is telling people for 6 or 7 figures in his consulting gigs and on his PowerPoint presentations, that U.S. shale oil is economic, is making big profits at $35 a barrel. That is not what the shale oil CEOs are telling people the truth, anonymously. So the real cost, the real break even for a lot of shale oil producers is $50 a barrel, and that's not free cash flow. Free cash flow is probably closer to $60, $65 a barrel, maybe even higher. And there's other higher marginal cost shale oil production. And this is why, as you can see on your screen there, that in 2019, there was a large amount of bankruptcy increases. And in 2020, we're already off to another large start in bankruptcy increases for U.S. shale oil producers. So this law firm that tracks this oil law firm that tracks bankruptcies is Haynes & Boone. Wolf Richter has this article out in the last couple days that U.S. shale patch sees a huge jump in bankruptcies, and he's quoting this new report that's out from the oil law firm Haynes & Boone, and Zero Hedge tracks a lot of these. And also shout out to Rick, who sent me this through Patreon. He's one of my over 200 Patreon account contributors, almost 250. And as an added bonus for Patreon account contributors, there's now, if you didn't see this already, there's a 20-minute long audio podcast in there exclusively for Patreon account contributors, going through my analysis of the uranium market, Cameco, the uranium royalty company, and the supply-demand fundamentals of uranium. Most importantly, in my opinion, risks for uranium investors or uranium speculators, the uranium spot price right now, and how we need to see it get to certain levels before there's economic mining done. And then also, in addition to the uranium royalty company, which some people were suggesting that I do some analysis on, it's in there as well extensively because I spent quite a bit of time looking through their investors' presentations and other materials, but also a little bit of an added bonus on Altius Minerals, which does have some uranium exposure, but they're more of a diversified portfolio royalty and streaming company that has some precious metals, more base metals, more energy exposure with uranium and coal, and then also I think a large potash royalty portfolio or stream portfolio. So they have good cash flow, Altius Minerals, if you've never heard of them, but the management team in the past had some very serious issues with debt. They used way too much debt, and I talk about that in the bonus podcast, as well as some other interesting tidbits in there. Another added bonus there, if you want to sign up for $5 a month, I think it's well worth it. There's a lot of other interesting audio podcasts and articles in there. I may write a written write-up for the uranium market for Patreon account contributors. I'll think about it, going into a little bit more detail. We'll see in the next week or two. So the market is weighing the missile strikes that happened versus the potential demand drop of basically the Chinese economy. A lot of major cities, you even have travel bans in Beijing with the lockdowns on that, and that means less people out on the roads, less people driving. Unfortunately for our friends in China who listen to this podcast, some of these major cities which are on lockdown, there's not food coming in. So the food delivery trucks, the grocery, the farmers or the produce companies that deliver the fresh fruits and vegetables or the proteins to market each day, those deliveries are not happening. The Chinese government is shutting those down. So hopefully our friends in China who listen to this podcast, and I don't hate the Chinese economy. I don't hate Chinese people. I'm not a Chinese basher. I heavily criticize the Chinese government, but I criticize every single government. So, I really hope that they can contain this coronavirus and they can get people healthy and, millions of people don't die. That would be absolutely tragic. But Christopher Martenson, I'm not an expert on that, so I'll just direct you. If you want to do more research on the coronavirus and how to protect yourself, Christopher Martenson, who is a PhD trained scientist and doctor, and he actually was, I think he studied viruses in school, so he has been putting out special updates on his YouTube channel. So definitely take a look at that, and he is monitoring all the news and information. So if you're into that, and you want to protect yourself, he is putting out all the news and information in our space. That's not my expertise. I'll just stay away from there. Let me talk about the oil market industry news, though, with the bankruptcies. So Texas is at the epicenter. Back to the Wolf Richter article, we're witnessing the destruction of money that loosey-goosey monetary policies encouraged. Following the sharp redrop in oil and natural gas prices in late 2018, we did have a rally, remember, in the first week or so of January, but now over the last 3 weeks or so, all those gains and more have been given back. So oil is in a clear bear market again, and the amount of capital available for these shale oil producers that already have too much debt, the capital is just not available for most of them. So for some of the low-cost shale oil producers, the capital might be available, or some capital, And some of these larger oil companies, if they have good balance sheets, there's going to be opportunities to go in and buy assets for pennies on the dollar at some point. But we just had recently McDermott International file bankruptcy, and they were an oil service company. And in 2019, we had Weatherford, another oil service company, file bankruptcy. So the oil patch is going through a very, very painful process right now, and the bear market is not over. I know a lot of people are bullish oil, like Peter Lynch and Keith McCullough and the people at Hedgeye and Jesse Felder, who's a very well-respected former hedge fund manager. I respect these people, and they did get a nice pop, a short-term rally in their oil trading, so congratulations to them if they made some pretty good profits. But I think the evidence is there, and I agree with Shy Girl on Twitter, who is an oil trader, and I think she also manages money for an oil investment fund now, that the oil industry has a lot more pain coming, and it's because of how inefficient and uneconomic the shale oil production is. And they're producing so much oil and wasting natural gas too, flaring it off, not storing it, not saving it for later. And they're producing so much oil and they're not making a profit doing so. It's just so stupid. But the Federal Reserve and large Wall Street banks, and unfortunately for a lot of pension fund investors, pension funds subsidized shale oil for so long. Okay, back to the end of rant, back to the article. Following the sharp redrop in oil and natural gas prices in late 2018, and now after oil price rallied, bankruptcy filings in the U.S. by already weakened exploration and production companies, oil field service companies, and midstream companies, which, if you're not familiar with the difference, midstream companies gather, transport, process, or store oil and natural gas. The pipeline companies, I think, are also considered midstream, jumped by 51%. So bankruptcies jumped by 51% in 2019 to 65 filings, according to data compiled by the law firm Haynes & Boone. This brought the total of the Great American Shale oil and gas bust since 2015 in these three sectors to 402 bankruptcy filings. The debt involved in these bankruptcies in 2019 doubled from 2018 to $35 billion. So the amount of debt in only a year that went bankrupt doubled. So it increased from a little under 18 billion, 17.5 billion to 35 billion. This pushed the debt total listed in these bankruptcy filings since 2015 to 207 billion. So 207 billion of debt since 2015 has gone bust. And remember, Chesapeake Energy, the natural gas producer, shale gas producer, I don't think they've gone bankrupt yet. They've been playing games with emergency capital raises at really high nosebleed terms to delay bankruptcy, but they're pretty close. They're on the edge too. They could go at, next couple months or so, maybe under 6 months. Educated guess. Again, not financial advice, but does not look good for Chesapeake Energy. Chart below shows the cumulative total debt involved in these bankruptcies since 2015. Okay, you can see this on the Zero Hedge article. It'll be in the information and description section if you want to look at the chart. This does not include the much larger losses suffered by shareholders that get mostly wiped out in the years before the bankruptcy as the shares descend into worthlessness, and that then may get finished off in bankruptcy court. The banks, which generally had the best collateral, took the smallest losses. Bondholders took bigger losses, with unsecured bondholders taking the biggest losses. Some of them lost most of their investment. Unfortunately, a lot of those are pension funds because private equity companies dumped it on pension funds for a long time. Others got high and tight haircuts. Others held debt that was converted to equity in the restructured companies, some of which soon became worthless again when the company filed for bankruptcy a second time. Again, this is just my opinion, not financial advice. It's not looking good for the deepwater offshore companies, specifically Seadrill. Seadrill's not looking good. They're under $2 a share last time I looked, and it looks like Seadrill, unfortunately, the creditors and investment bankers and other bankruptcy experts, and I'm using air quotes, really screwed Seadrill over after coming out of bankruptcy. And Seadrill had, from what I remember, the last time I looked at the company, they had a debt to cash flow ratio. It was $200 million in annual cash flow and $5 billion in debt. So a ridiculously bad debt to cash flow ratio. And their debt to equity ratio, if I remember correctly, the last time I looked at it, it was 5 times as much debt as there was equity for Seadrill. So it's looking really, really bad for Seadrill again, especially with oil prices dropping, that Seadrill could have cancellations on their contracts for deepwater offshore drilling, and Seadrill may be going bankrupt again a second time in the near future. It's just really sad. This is not the fault of Seadrill management after coming out of bankruptcy like this. This belongs the fault belongs at the feet of the creditors and the bankruptcy experts that did a real disservice to the company after it came out of bankruptcy the first time. Most of those debts are supposed to be discharged. When a company comes out of bankruptcy with a debt to equity ratio like that and a debt to cash flow ratio like that, you're not giving the company a chance to start over. The Great American Fracking Bust started in mid-2014 when the price of WTI dropped from over $100 a barrel to below $30 a barrel by early 2016. Price began to recover, going over $70 a barrel in September and October 2018, but then it began to replunge. By the end of 2018, WTI dropped to $47 a barrel. Two major geopolitical events in the Middle East, the attack on Saudi Aramco's oil facilities last September and the U.S. assassination of Iranian Major General Qasem Soleimani, that would have shaken up oil markets before, only caused brief ripples, quickly squashed by the onslaught of surging U.S. oil production. At the moment, WTI, okay, so this article came out a couple days ago. WTI only a couple days ago was at $56.08 a barrel. We're already down to barely $53.04. So oil prices are down $3 a barrel in only a couple days. Now, if by some miracle the Chinese government was able to prevent the virus from spreading all over mainland China and cure a bunch of people very, very quickly, that could cause a rebound in oil prices. But from what I'm reading about the coronavirus and the spreading in China and how authoritarian and strict and behind the curve China has been, and Chris Martenson has been talking about this on his videos, it does not sound like China's gonna be able to fix things this quickly. They're building those medical facilities outside Wuhan, over 1,000 beds, very, very quickly, but some of those people who are already infected are not going to be lucky enough to benefit from that. Okay, back to the article. Okay, the price that the WTI price is at, was at a couple days ago and is at now, is below where the shale industry can survive long term. And 2020 is starting out terrible for natural gas producers. I've talked about this also in the last month. There's a natural gas episode in the archive if you want to listen. There's a ton of natural gas byproduct being flared from shale oil production. So all that increasing oil production in the Permian that was producing an extra 1.6 million barrels per day in the last year, there was a ton of natural gas product, shale gas, and a lot of it was just flared off. It was not saved or stored because it was not economic to build the storage facilities and pipelines to send it to LNG export facilities or somewhere else to do so. Price of natural gas plunged to 1.9 per million BTU at the moment. Let me see if it's changed significantly since the article came out a couple days ago. Let's see here, natural gas. Natural gas actually up a little bit. Natural gas is actually up, according to this, about almost 4%, 3.69%. So that's a little counterintuitive. Okay, back to the article. Producers in shale fields that produce mostly gas, such as the Marcellus, are in deeper trouble because oil, even at these prices, would be a lot better than just natural gas. Producing areas with constrained takeaway capacity takes a lot longer to build pipelines and to ramp up production, are subject to local prices, which can be lower still. So what that means is that at the wellhead, because of all the transportation costs for oil, so in oil production areas like the Bakken, there was a big discount. Not sure if there's still a big discount, but there was for years of oil production at the Bakken. It was $10 per barrel cheaper at one point because it was expensive to put the Bakken shale oil on a train. Couldn't pipeline all the oil down, so you had to put it on a train. You had to pay for transportation costs and insurance and all those different added costs to get it down to a refinery. And then also the refineries are not able to process all the shale oil all by itself. It has to be blended with heavy sour crude. So a lot of the U.S. oil refineries actually switched over a long time ago, especially the Gulf Coast ones, to refine more heavy sour crude. And so all this shale oil production has to be blended with heavy sour crude for U.S. oil refineries to refine it properly into gasoline and all the different petroleum products. Producing areas in some areas such as the Permian in Texas, New Mexico, most prolific oil field in the U.S., where natural gas is a byproduct of oil production, limited takeaway capacity has caused local natural gas prices to collapse, and flaring natural gas, basically just burning it off, to surge. It's absolutely massive. Supposedly you can see the flaring from space. That's what I heard. You can see images from space. the flaring is so massive. Texas is at the epicenter of bankruptcy, the most affected state in terms of the number of bankruptcy filing. Is Texas the largest oil producer in the U.S.? Since 2015, the state had 207 oil and gas bankruptcy filings. Of the 402 total filings, over 50%. 2019, Texas had 30 of the 65 filings. Delaware obviously is not into oil and gas production, but into coddling corporations. Just funny. And many companies are incorporated in Delaware, including some oil and gas companies in Texas. When they file for bankruptcy, they do so in Delaware. These are the 8 states with the most oil and gas bankruptcy filings, so Texas and Delaware are 1 and 2. Bankruptcy filings are triggered when the exploration and production companies no longer get funding from Wall Street or from their banks to continue with their perennially cash flow negative operations and service their debts, or these shale oil unicorns are no longer able to sucker pension fund investors or pension fund investment boards or the pension fund portfolio manager who got nice vacations or trips, paid trips to oil conferences. And this is what is happening now. Wall Street and the banks have started to demand that these companies stick to an entirely new mantra in the fracking business: live within cash flow. Actually, if a lot of companies live within their cash flow, I think the economy would be a lot more efficient. There would be less credit booms and busts. But unfortunately, that's not how the economy functions now with Silicon Valley unicorns and shale oil unicorns. When E&P companies run short on funding, they cut back on drilling activity, which puts the squeeze on oil field service companies that normally have to discount heavily to get any drilling business at all. And this article doesn't talk about it, but the other thing is CapEx, capital expenditure. Capital expenditure means employees could lose their jobs. Less CapEx investment means human beings are not going, there's not going to be more jobs. And in the service sector jobs that surround that town, so the restaurants, the bars, maybe the brothels, maybe the shopping malls, I don't know. I haven't been to one of these oil boom towns. I have some friends who were up in the Bakken for a little bit, and they told me all the crazy stories that it was not even safe at one point because how bad the roads were and how many people were drunk and on drugs during the day driving, how dangerous it was years ago. So it was like literally a mining boom town, and then I think over 90% of the Bakken at one point was all men, and most of the women in the town were strippers or escorts or hookers. Anyway, back to the article. When E&P companies run short on funding, cut back on drilling activity, which puts squeeze on oilfield service companies that provide products and services to the oil field, including drilling and completing wells. And in these oil field service companies go bankrupt. More likely what they do before oil field service companies go bankrupt is they actually cut the cost to drill to incentivize anyone to pay them to drill, and then they sacrifice their margins. And you could see this on their income statement, and this is why you have companies like Schlumberger and some of the others where over 2019, and I covered this in the last week or so on another show, that Schlumberger, which is one of the largest, if not the largest oil service company in the U.S., that they had a $10 billion loss. So Schlumberger had a lot of revenue still. The revenues did not collapse, although the revenues did fall in the U.S., but they were discounting too much, and that's why they lost money, because they were not charging a high enough rate to make a profit for shale oil drilling. So in its report on the oil field service company bankruptcies, Haynes and Boone cited pressure from Wall Street and its cascading effect, which Weatherford had pointed out in its bankruptcy filing. We note that Weatherford, in its July 2019 filing, attributed its insolvency in part to reduced drilling activity by producers who have also been dramatically affected by the commodity price slump since 2015. Investors' pressure on producers to live within cash flow, which they should have been doing anyway, but apparently no one likes to do in any sector of the economy anymore. I mean, look at Boeing. Boeing just borrowed another, $10 billion from creditors to maintain their dividend. And their stock price is probably still going to end up going back up because they announced that they're going to maintain their dividend. I saw their stock price on Friday, I think, had a rally on that PR announcement that they wouldn't cut their dividend, that they added more debt to their balance sheet. Producers to live within cash flow is further reducing demand for oilfield services and supplies, leaving the oilfield services sector with little near-term hope for turnaround in prospects. So the amount of job growth in the U.S. over the last decade, a lot of it in specific states, a lot of it occurred in North Dakota and Texas. There were big increases in investment and jobs for humans. Not necessarily profitable investment returns in those oil investments, but humans did get the benefit of that with more jobs, higher paying jobs, things like that. And now we're in the reverse, where the service jobs around the oil areas for there are in trouble. There's less investment, so people who are oil workers in that area are going to be asked to either take a pay cut to keep a job, or they're going to be fired. This is why CapEx, capital expenditure, is so important to employees and humans who want to keep their job. Okay, what the sector needs are much higher prices for oil and natural gas. And again, we're seeing the opposite for oil. We're seeing more pressure on the oil price because now the market is saying that the most important thing right now, at least in the short term, is the coronavirus in China and how that's affecting how many Chinese will be driving and the amount of goods moving through China. And so until the coronavirus, something is solved on a more permanent basis in China, or we find out that we have a antidote that we can, vials that we can manufacture quickly, the oil price is going to be under some pressure. That's what it looks like. Because the oil market just shrugged off the U.S. Embassy getting attacked in Baghdad, the missile attacks. Fresh rocket attack scores direct hit on U.S. Embassy in Baghdad, and the market didn't even blink at this. So the market is, people are like, the market doesn't care about the rocket attack on the U.S. Embassy in Baghdad, and I would say, yes, it does. It weighed that versus the demand drop in China of less Chinese now. Chinese are literally in Wuhan, from what I've heard from reports in Wuhan, people are not allowed to be driving. Private citizens are not allowed to be driving in Wuhan now. So I'll try to find out from my source in mainland China, one of my main sources in mainland China, who is from Wuhan, to see if that's true. But that's what I've heard. John says the U.S. Embassy is a fortress. Nobody seriously hurt. However, John, I would argue that in the past, just this news story would have spiked oil prices a couple dollars. People would have gotten worried in the past without the U.S. producing insane amounts of U.S. oil, shale oil production at a breakneck pace, and doing it uneconomically, that a geopolitical tension rising like this would have moved the oil price the exact opposite direction a couple dollars, and that's not happening. GDC says he thinks he saw a show about the coronavirus, something like Walking Dead. Yeah, they're ghost towns. I think there's curfews, and a lot of people are not supposed to be out walking. Regular citizens in China are not supposed to be out walking in the cities and the streets. Small mortality rate so far. Do you really trust the official numbers from the Chinese government? I'm not so sure. I mean, their economic data is more fraudulent than a lot of other countries, and every country is lying about their economic data, but the Chinese have the most fraudulent, most corrupt economic data, so I don't know if I believe anything coming out of China about those numbers. About how many people are infected, how many people have died, I don't know if I believe any of that. Again, I'm not a doctor, so I'm not an expert at the coronavirus. I highly recommend watching the videos that Chris Martinson at Peak Prosperity is putting out. He did a podcast interview in the last day or two with Craig Hemke at TF Metals, and he's been putting out short video updates on that. I'll just stick to how the coronavirus in China is impacting the oil market. I got a number of super chats. That's great. Thank you very much. David DeForest, who's a Patreon account contributor. So thank you, David, for being a Patreon account contributor and the super chat. He says, George Gammon sent a bunch of people here tonight. That is great. Hopefully, I can get to 35,000 or 40,000 YouTube channel subscribers quickly, because it seems that George Gammon is the main driver of my growth now. That I'm not able to add any new YouTube channel subscribers anymore on my own. It's just not happening. Google downranked my YouTube channel and my Patreon page to really low in the search, behind a Twitter account, a business Twitter I don't even use anymore, and a website that gets no traffic. They downranked my YouTube channel in search that much. I'm still getting over 100,000 views per month, and they move me down in search so no one else finds my channel. hopefully, I know a lot of larger YouTube channels like SGT Report and others listen to this. Hopefully they'll help me out and help promote the channel so it'll grow faster. But I know like SGT Report and some other large, Sean at SGT Report and others listen to my content. So hopefully they'll start promoting me more so the channel will grow faster, because I'm not going to be able to do it on my own anymore. Okay, thank you very much to Ali Van for the $2 super chat. He says, thanks for your insights. You're welcome. You're welcome. I'm just going to try to stick to the impact of the China coronavirus on the oil market, and that means that less adult Chinese with cars, with motorcycles, with scooters, with trucks are going to be able to drive. So that's what the oil market is currently factoring in, the WTI price and the Brent price. Okay, Justin routinely gives me super chats. Thank you very much, Justin. Justin, are you also a Patreon account contributor? There is a lot of unique content behind the paywall there. So I see you donate $1 per show a lot. For $5 a month, you can get some interesting articles and extra audio podcasts too behind the paywall, if you want to take a look there. Chicky40 Noobs. SGD, I'm not sure which currency that is. 14 units of that currency. Thank you very much for that. I appreciate it. Okay, let me take a look at more listener questions and comments, and then I'll shut down this short show. The full oil bankruptcy report is linked in the Zero Hedge article from Wolf Richter, also on Wolf Richter's website, and on the Haynes and Boone legal website. Now, if China were to miraculously figure out how to solve this, and they were to manufacture a cure very quickly, or let's say the virus mutates, and this is from Christopher Martinson. I'm not a doctor. I don't know this stuff on my own. This is from listening to Christopher Martinson. Let's say miraculously the coronavirus mutates into an easier way to cure it, and we're able to, in a week or two, prevent lots of people from dying, then the oil price will probably rally. But I would put that probability pretty low, in my opinion. Again, not financial advice, just my opinion. It's not looking good for oil prices in the short term, which is going to put even more pressure on the U.S. shale oil producers. Now, the shale oil producers, the ones who hedged a couple weeks ago, and there was a lot of them, the ones who hedged are going to be in pretty good shape. So if they hedged at $63 a barrel for the next couple years, a large chunk of their oil production, this oil price dropping $10 a barrel in 3 weeks or so is not going to hurt them nearly as much. Another super chat from Wally. Thank you very much. You routinely donate in super chat. Are you also a Patreon account contributor, Wally? I don't think the coronavirus is a distraction at this point. I think you should prepare accordingly. I do not think it's a distraction. I think it's very serious. I don't know how many people are going to die, but it's very serious. Hopefully they can come up with a cure quickly. Should definitely prepare accordingly. I think Christopher Irons, my buddy at QTR podcast, he said that they sold out. He posted a screenshot that they're sold out of the N95 masks on Amazon. I think they're sold out. Dave says he was watching some videos of Wuhan and it looks bad. Yes, it does look bad. It looks like a scene out of like Walking Dead or the Resident Evil movies, except for the crazy mutated monsters, the dogs, and the zombies in Resident Evil. But a lot of the other stuff looks similar to Resident Evil. Again, this is not health advice. I'm not a doctor, but take a look at the Silver Health Institute, and there's a section there on structured silver solution and colloidal silver and some other research showing what silver does to viruses under a microscope. Oh, another super chat. Thank you very much for the $5 Canadian. Okay, well, that's it for tonight. I'll put links to all the articles I discuss in the information description section. I was just kidding about Resident Evil, guys. Come on. There's no zombies running around. People are not killing each other. It is like the test facilities. There is 2 test facilities, though, for the infectious diseases like Ebola, the viruses, and the pathogens in Wuhan. And that is similar to the Umbrella Corps. They're doing very nefarious things there. And did you see that there were 2 Chinese spies arrested in Canada, and they're trying to steal a strain of the coronavirus? So no, it's not Resident Evil. God, you guys can't take a joke at all. Okay, that's it for tonight. Thank you very much to all my over 200 Patreon account contributors and monthly PayPal contributors. There's around 250 actually now total. So that's really good. Hopefully there will be almost 300 by the end of this year. And thank you very much to people who tip me once in a while. I also take the top 6 cryptocurrencies if you want to tip me in cryptocurrencies. The addresses will be in the information description section along with the link to my Patreon account. If you want to sign up there, and you can listen to the new podcast on the uranium market, which is one of the few contrarian sectors left, one of the few industries that's not drastically overvalued. I don't know when uranium is going to go back in a bull market, but a lot of the stocks are dirt cheap. So you can't really say that about too many sectors anymore.